Hi, in this chapter we will talk about the periodicity assumption or the time period assumption, and we will also discuss the accrual basis of accounting and the cash basis of accounting and see the difference. We will also learn about adjusting entries and the major types of adjusting entries, mainly deferrals and accruals, and at the end we will prepare a trial balance and an adjusted trial balance, which is usually used in order to prepare financial statements. Before we talk about accruals, the life, as you remember from previous chapter, we said that corporations, they have an indefinite lifetime. However, because it's hard to deal with an indefinite lifetime, accountants, they found it useful to split the life of a company into artificial periods. Now, that creates an issue. So those artificial periods are usually like a month, a quarter, or a year, and that makes it easier to handle the information and to report on a timely basis. Now, the problem is that using these accounting periods requires some kind of adjustments. We need to learn or to, especially when we have events that occur or that roll over into the following accounting period. Say if you pay in advance something in advance. If we could wait until the end of the life of a company, everything would be easy and it would be clear, so we wouldn't need to make any adjustments. But because of these these time periods, we need to provide periodical statements, and as a result, sometimes we may need to make certain adjustments. Take, for example, the management's needs for monthly reports. The IRS also, they require annual tax returns. So we will need to make those adjustments in order to say, okay, what did happen during this accounting period? So if we're talking about the month of April, we need to know what revenues we had during that month and what expenses we had that month. Basically, we need to know what transactions are to be recorded for the month of April. Now, monthly and quarterly time periods are usually called the interim periods. The annual time periods are the fiscal years. Now, fiscal year doesn't always have to be exactly like the calendar year. For many companies it is. However, a lot of companies, they have different fiscal years. For example, it could start from July 1st until June 30th of the following year. Basically, it is 1 year that accounting transactions are recorded for that 1 year. And publicly traded companies, they have to prepare and publish quarterly as well as annual financial statements. So, for example, the time period assumption states that revenue should be recognized in the accounting period in which it is earned. Expenses should be matched with revenues. The economic life of a business can be divided into artificial time periods. The fiscal year should correspond with the calendar year. Well, we know that it doesn't talk about the revenues or the expenses. The time period assumption is actually C, because D is false actually, because fiscal years, they don't always have to correspond with the calendar year. Now, well, under US GAAP, companies are required to use accrual basis accounting. And what do we mean by accrual basis and cash basis accounting? Accrual basis accounting, simply states that the revenues must be recorded when they are earned, and expenses must be recorded and recognized when they are incurred. So basically, when you provide a service, you earn the revenue. When you make a sale, you earn the revenue, regardless of whether you have received the cash or not. And same thing applies to expenses. Whether you have paid in cash or not, as long as you have received the service, as long as you have incurred those expenses that are associated with generating the revenues, you have to recognize those expenses for that accounting period. So basically, the transactions recorded in the period in which they occur, where the event occurs, and not when the cash is exchanged. On the other hand, cash basis deals with cash. Basically, revenues are when you receive cash. So when you make a sale, it doesn't matter as long as you haven't received cash. So for cash under cash basis accounting, you only record revenues when you actually receive cash, and you only recognize the expenses when you pay in cash. So it's cash in and cash out. And throughout this semester, throughout all the courses, we will be dealing with accrual basis accounting, because under cash basis accounting, we cannot under US GAAP, companies are not allowed to use cash basis accounting. However, one would think about cash basis in a way like, why would anyone want to use cash basis? The thing is that here, cash basis could be misleading. How? Take for example a transaction like how most companies do business. They usually make a sale or provide a service, and then they give their customers 30 days or 60 days in order to pay. So they won't bill them immediately. What happens under cash basis? Under cash basis, this will not be recognized at all. At the same time, expenses. If, for example, a company buys an insurance policy, so this insurance policy for, let's say, $1,200 for a whole year. According to under cash basis accounting, the company would recognize the $1,200 as completely as an expense in the first month, but for the subsequent months they won't have expenses. That would be a little bit misleading. Think also about equipment. So if the company buys a truck to deliver packages, let's say that UPS or FedEx or USPS, they buy a truck in order to for their main line of business, which is delivering packages, which would lead to revenue generation. So under cash basis, the company would recognize the full price or the full cost of this truck in the first year. However, let's say that the truck is going to be used for 10 years and UPS bought it for $50,000. Does it make sense to charge the whole amount for the first year and the remaining year and the 9 years where the truck will be used to generate revenues? Shows that there was nothing. In this case, what would happen is that in year one, basically, in year one, the company will have expenses of $50,000. On the other hand, let's say that they had revenues $10,000. In this case, they have a net loss of minus $40,000. Now this is a little bit misleading, because in year two, the company would have expenses 0 and revenues. Let's assume that they also get 10,000. In this case, they have net income equal to 10,000. Now this is assuming that there are no other expenses. Now what the problem here is that if anyone looks at the performance of this company, they look at the first year it was minus 40, second year it's plus 10, so they expect that it will continue to grow more or less like that in this same pattern. But this is not the truth. The truth is that what happens is that the year 3, so this is year 2, year 3, it will still be 0 and 10,000, which would make it again 10,000. This is a little bit misleading. Under accrual basis, the company would record it as the revenues are record the expenses as the revenues are generated. Now, however, cash basis accounting is sometimes appealing because it's very simple. It's easy to it's very easy to basically to do the math here. You receive cash, you recognize the revenue, you pay cash, you recognize the expense. But whenever you make a sale without receiving cash, you don't have, for example, receivables. And this is usually like individuals and small businesses, they may use cash basis. However, medium and large businesses, they always use accrual because it is under US GAAP, it is required. Throughout this semester, we will be talking mostly about accrual basis accounting. And we will be recognizing revenues and expenses according to accrual basis accounting. Now, under this basis of accounting, the revenue recognition principle states that the company should recognize the revenues when they are earned. So basically, it's when the service is performed, regardless of when the cash was exchanged. So this is in the case of a service, and in the case of a sale, same thing. When the company sells a product, the revenue is recognized when the product, when the sale is made, and not when cash is actually exchanged. And it has so this event. The event that has happened, which is providing a service or making a sale, it should be recorded in the same accounting period. And this is also more or less similar to when we talk about expenses. So here we have the expense recognition principle. It says that, or sometimes also called the matching principle. This is where the expenses, they follow the revenues. And what do we mean by that? As you remember, expenses, they are resources that the company uses in order to generate revenues. And as a result, all the expenses that the company has incurred to generate certain revenues, they have to be recorded at the same time as those revenues. In other words, the effort, they must be matched with the results, or the expenses, they have to match the revenues. And whenever the expense is not paid in the same accounting period, then it becomes a payable, it becomes a liability or an obligation that the company has to fulfill later on. This is a summary of what we have been talking about. This is where we talked about time period assumption, where the economic lifetime economic life of the business is split into artificial periods of time, and the revenue recognition principle says that the revenue has to be recorded in the when they are earned, basically when the event occurs in the same period that the event occurs, and expenses, they have to match or follow these revenues. And this is what we mean by the revenue and expense recognition under the accrual basis under US GAAP. An interesting point here to discuss is where accrual basis accounting is manipulated in order to cook the books. And what do we mean by cooking the books? Basically manipulating the numbers to mislead investors and creditors and other stakeholders. So for example, consider the scenario where a company does not earn enough revenues during a certain year. Yeah. Most companies, they have as a goal in a way, they try to meet or beat financial analysts forecasts. And those financial analysts, they analyze the performance of the company, and they predict a certain certain earnings, a certain number basically for these companies. And then the company, if they fall short, their stocks are affected, and basically their stocks are usually they drop. Stock prices drop. To avoid that, certain companies, certain, like sometimes management, they have they can, for example, boost their sales. Take for example a scenario where a company, let's say a computer company, they cannot they fall short on their forecast, and in order to boost their sales, they can, for example, go in December and make a huge sale. What happens is that because of this huge sale, a lot of people and on account, for example, it's not just a huge sale, but it's also on account, and without basically taking into consideration the risk of people defaulting and not paying their debts in the future. So what happens is that their earnings will rise at that point a lot, and they will meet their financial analyst forecast. The financial analyst forecast. What happens? The problem that could happen is that, what about next year if a lot of people default? At that point, they will not be able to pay their debts, and the company will rather be losing money. So this is a scenario where, in order to improve their earnings now, they may be eventually hurting hurting their future performance. And as we can see here, Krispy Kreme, they also once there was an allegedly, basically what they did, they used to boost their sales at the end of the quarter, and by striking a deal, for example, certain places where they would strike a deal with their wholesale customers, and they would send them large amounts of donuts that would be returned right after the quarter has ended. But that would also lead to a loss in the sales. Eventually, it would lead to a loss, but at the for the short time, it would boost their quarterly results. This is just to see if we still this is a summary now. Let's look at this question. Which of the following statements about the accrual basis of accounting is false? Events that change a company's financial statements are recorded in the periods in which the event occurred. Revenue is recognized in the period in which it is earned. The accrual basis of accounting is in accordance with generally accepted accounting principles, and revenue is recorded only when cash is received, and expenses are recorded only when cash is paid. As we can see, under the accrual basis accounting, only the last one is incorrect, because this is the cash basis accounting. Now let's consider this small problem. Lamb Company had the following transactions during 2011. Sales of 9,000 on account, collected 4,000 for services to be performed in 2012, paid $1,250 cash in salaries, purchased airline tickets for $500 in December for a trip to take place in 2012. What is Lamb's 2011 net income using accrual basis? So first of all, what they are asking us is to calculate the net income. So this is what we're looking for. How do we solve this? They are asking us for the net income, and under accrual basis. So in this case, we'll look at the transactions one by one and see if we can if we can recognize it under accrual basis for 2011. So now we are looking for 2011. The first one is sales of $9,000 on account. So those are sales in 2011. As a result, we include it in our calculations. So this is 9,000 plus 9,000. Collected $4,000 for services to be performed in 2012. So the services will be performed in 2012. As a result, we don't recognize them now, and we don't include them in the net income. Paid $1,250 cash in salaries. So this was paid now. This is minus 1,250. Purchased airline tickets for $500 in December for a trip to take place in 2012. Once again, this will be used, the event will take place in 2012, and we do not include it in our calculations. This is why the answer is 7,750. This is a list of concepts that we need to match with their definition. So accrual basis accounting would be which one? Accrual basis accounting is where companies, they have to record the transactions when they as they occur, and this is why it's F. The calendar year, this is from January 1st and ends December 31st. That's E. Time period assumption. This is where the lifetime of the business is split into artificial periods. It's C. And the last one is expense recognition principle, which is B. This is where the effort, they have to, or let's say the expenses, they follow the revenues. So so under the accrual basis accounting, we need to record revenues and recognize expenses in the periods where they are earned and incurred respectively. And in order to do that, in order to make sure that the revenues and the expenses are recognized in the period where the event has occurred, sometimes we need to make some adjusting entries. Originally, the trial balance that we studied so far includes information from the original entries, and as a result, by the end of the accounting period, the information in that trial balance may not be up to date or complete. And the reason for that is that certain events happen on a daily basis, but we don't record them. They don't need necessarily happen on a daily basis, but we don't need to record them every day or every time we use them. For example, when we use supplies, or when we have salaries or interest, when interest starts accumulating. We wait until the accounting period, the end of the accounting period, and then we recognize them. In certain cases, there are expenses that we pay in advance. However, so we pay them in advance, but we recognize them later on, such as insurance. When we pay insurance in advance, we are using it subsequently, but we don't record it at the same time. Then we also have certain revenues that we might be paid, for example, in advance. And we have already talked about prepaid expenses and unearned revenues, and we will talk about that a little bit more in advance, later on. We also have sometimes certain items that will not be recorded until later on. For example, when we receive a utility bill for the future or something like that. And this is why companies, right before they start preparing the financial statements, every time they make certain, basically they have to prepare those adjusting entries that would fix this this information and would update the trial balance. And usually those adjusting entries, they include, or they would include, one income statement account such as revenue or an expense, and one balance sheet account such as a liability or assets. There are two main categories of or types of adjusting entries. We have the deferrals and the accruals. So deferrals, they would include prepaid expenses and unearned revenues, whereas accruals, they include accrued revenues and accrued expenses. So accruals, as the name suggests, this is an accumulation of revenues or expenses that have not been recorded or recognized yet. Whereas with prepaid expenses, this is when we pay expenses in advance. In return, this is when we pay in advance in return for services or products that we will be receiving in the future. Unearned revenues is where we actually receive cash, when the company receives cash before they actually provide the service or make the sale. So it is actually before the event has occurred. And as you remember, this is from the this is the trial balance. We will use the trial balance here in order to as a starting point, and then we will update this information. Once we have this information updated, we will end up with the adjusted trial balance. Now, we will start with the deferrals, and deferrals are costs or revenues where the recognition is postponed. In other words, we recognize them at a date later than they actually occur. We need to make therefore, basically, we need to make adjustments to record the part that was incurred or recognized during the current accounting period. Take insurance policies, for example. You start, let's say you pay in advance for a whole year. So basically what you need to do in this case, you need to recognize the part that was used during this month. Or let's say unearned revenues. This is where you get cash in advance for services that you will provide in the future, but you will start earning it as you start providing services, and we'll talk about each one of them in detail. So prepaid expenses, we talked about in the previous before we talked about prepaid insurance expense. So in this case, this is where we pay the cash first, and then we so we record it as an asset first, and then this prepaid expense, we start expensing it at the end of each accounting period. So this is basically an asset that we will be using in the future to generate revenues. And there are several examples of this. We talked already about insurance. We can talk about supplies. We have equipment, building, rent, etc. So, for example, those. Well, let's talk about supplies first. Basically, let's say that we buy an amount of $5,000 worth of supplies. The original entry was where we debited. For the original entry, let's say that we bought them cash. So it was we debit let's say October 4th, we debited supplies 5,000, we credited cash 5,000. However, during the month of October, so this is the original entry, and the trial balance will show at the end that supplies is 5,000. But let's say that at the end of the accounting period, at the end of October, we found that we have used $2,000 worth of supplies. Do we still have $5,000 in supplies? That would be misleading. It's not correct. So we need to adjust for that. We need to decrease supplies by 2,000. Those are the supplies that were used during this time. And where does that go? Well, we use those supplies in order to generate revenues, so those go to supplies expense. As a result, what we do, we decrease supplies by 2000 and we increase supplies expense by 2000. And prepaid expenses, those are the costs that would expire. Usually they expire either with the passage of time or through use. Passage of time, for example, when you pay when you prepay insurance policies or when you prepay rent, or through use. This is like supply, like this example here where we used supplies. Now, in general, it is impractical and it's not efficient to make daily entries for the supplies that we have used. So every day, every time, you're not going to make a journal entry every time you use a pen or a pack of papers. So what do? You wait until the end of the accounting period and then you look at how much you still have on hand. So this is where you look at the remaining part. So at the end, you see that this is how much you still have. Let's say at the end, we had the value of the supplies was $3,000. What does that mean? That means that during the month of October, we used $2,000 in supplies. And as a result, those are supplies expense. Those are expenses that we use in order to generate revenues. Now, so this is why always, as we did before, what we did, we needed to, the adjusting entry, what we needed to do was to decrease the asset supplies. In that case, it was supplies. So we decreased, so here, an asset account. In the example, it was supplies. And we increased an expense account that was supplies expense. Now, as you remember, expenses are debit. So in order to increase them, we debit the account supplies expense and we credit the asset account supplies in order to decrease it. So as you can see here, this is the unadjusted balance here. This is the unadjusted balance of the asset. It was supplies. Here we credited the asset and we debited the expense. So let's look at this example. Pioneer Advertising Agency purchased supplies costing $2,500 on October 5th. Pioneer recorded the payment by increasing, or just doing debiting, the asset supplies. This account shows a balance of $2,500 in the October 31st trial balance. An inventory count at the close of business on October 31st reveals that $1,000 of supplies are still on hand. Whenever you see this expression are still on hand, it means this is what you are left with. This is the ending balance of supplies. And the difference between the ending balance and the original balance is actually the amount of supplies that was used. So here, if we leave the trial balance without adjusting, without adjustment, well, the information would be wrong. Actually, it will be outdated because it will reflect the time where the supplies were bought on the 5th of October and not at the end of the month. So in order to fix this, we make a journal entry and like we said, we need to, so the amount, the expense here, so the supplies used are 2,500 minus the 1,000 that remains, which is $1,500. This is the amount that was used for during the month of October. As a result, we need to increase the expenses, supplies expense, by 1,500. So we debit supplies expense 1,500 and our supplies, the asset account supplies, decreased by $1,500. As a result, we credited $1,500 and that would be the adjusting entry. As you remember, it will not be practical to make daily records. This is why the companies usually they wait until the end of the accounting period and then they count whatever supplies they had or inventory. And the difference between the two would give us the supplies expense. This is how we made the analysis. We looked at the equation. Supplies decreased by 1500 and expenses that the supplies expense increased by 1500. Remember that this minus here reflects or indicates the negative effect that expenses have on stockholders' equity, because in this case stockholders' equity will decrease by $1,500 and assets they decrease by crediting them, and debits they increase expenses. So we debit supply expense and we credit supplies, and this is how we post it to the ledger accounts. Now, as you can see here, it is important to indicate that this is an adjusting entry to make sure that to make sure that this is distinguished from the original entries. Without those adjusting entries, the net income would have been overstated by $1,500. Why? Because we would have the same revenues, but expenses would be understated by $1,500. And the same thing could also be said about assets. So assets would have been overstated in that case. So assets would have been overstated by $1,500, because in the trial balance we were saying that we had an asset value of 25, an asset account of $2,500, whereas in reality we only had 1,000 in that account. On October 4th, Pioneer Advertising paid $600 for a 1-year fire insurance policy. Coverage began on October 1st. Pioneer recorded the payment by increasing or debiting prepaid insurance. This account shows a balance of $600 in the October 31st trial balance. The insurance of $50 expires each month. Here, this is similar to the example that we discussed before. This is where the company paid in advance a 1-year insurance policy. Now, this insurance policy will have to be split over the useful life, or basically over the time that it will cover. So every month, $50 of insurance will have expired. Now, on the unadjusted trial balance, it reflects the original value of prepaid insurance. This it will show it as $600. So the trial balance does not have the most up-to-date information where it would show that we have already used this month. The month of October has already been used. So the insurance policy used to cover 12 months, but after the month of October has passed, we are left only with 11 months coverage in that insurance. And this is why it was originally recorded, like we said here, when we bought, let's say that we bought it as cash, it was prepaid insurance was for 600, cash was credited 600. But now we have to adjust for that one. We need to expense the part that was used in October, that's $50. So as a result, we decrease prepaid insurance, which is an asset, so we by $50, and we have used this as insurance expense. So this insurance expense has increased by $50. So we debit insurance expense 50, we credit prepaid insurance 50. And the analysis for this one would be as usual. We have our asset prepaid insurance decreased by $50, and so it will be credited. Insurance expense has increased by $50, and so it will be debited. once again we post this to the ledger, and again remember that we have here adjusting balance. And as you can see, we still have for this transaction as well, we have total credits, so credits and debits should also be equal, again to maintain the equality of total credits and total debits. Depreciation is another kind of deferrals. Basically here what we're doing is we're taking we are looking at the cost of the asset, for example, let's say a truck or a building, and we are allocating or splitting this cost over as expenses over the useful lifetime. For example, if the truck is expected to serve the company for 10 years, then we depreciate it over 10 years. Now, it is very important to understand that depreciation is not a valuation concept. This is basically, we're not saying that this is the new value of the building. We're just saying that we are allocating the cost so we are allocating the cost as an expense for every accounting period to match it with the revenues that were generated. Take for example the truck example. In this case, let's say a truck costs 50,000 and it's going to serve us for 10 years. So in the simplest way, depreciation would be splitting the cost over 10 years. In this case, every year 5,000 of the cost of this asset will be expensed, will be recognized as an expense to match the revenues that were earned during that year. So companies record buildings and equipment, etc. at cost. This is the cost principle. Basically, we need to record it first at cost. This is the initial cost when it acquired it, and they have to keep recording it at cost. Then they allocate a portion of this cost as an expense every year or during every accounting period, basically for the expense recognition principle. This is why we need to make adjusting entries to recognize the cost that has been used. This is the expense during that year or that accounting period. For example, for Pioneer Advertising, assume that depreciation on the equipment is $480 a year or $40 per month. Later on in the semester, we will learn how to calculate depreciation. But for now, for the first part of the course, we will be given the amount of depreciation more or less. So in this case, instead of directly crediting the asset equipment directly, which would in order to decrease the asset, the companies introduce a new account that is called accumulated depreciation. Remember that companies are expected to record the assets at cost, and then they need to keep recording it at cost. So for example, if they buy if Rutgers buys a building, for example, for $5 million, next year they have to keep recording it at $5 million. If it costs them $5 million, this is how much they have to report it every year. Let's take here the example of depreciating equipment. So originally, so this here, it's $480 per year or $40 per month. So what's happening? What's happening is that every month, this amount, the depreciation, that we recognize will be recorded as depreciation expense. This will be recorded as a debit to depreciation expense, $40, and then we credit accumulated depreciation. Now, here accumulated depreciation is a contra asset account. Rather than crediting equipment directly, like we did with supplies expense, for example. We did supplies expense and we debited supplies expense and we credited supplies. In this case, we cannot credit equipment because that would violate the cost principle. Instead, we credit a new account that is called accumulated depreciation, which is a contra asset account. That's a credit account. And the way it acts to more or less in contrast with equipment. So later on we will treat them as more or less as a bundle. So it would be equipment less accumulated depreciation for equipment. And on the in the ledger as well as on the balance sheet, accumulated depreciation, it shows immediately after the asset. So the contra asset will show up immediately after the asset. This enables companies to keep track of the total amount of depreciation taken over the life of the asset. So it shows the original cost as well as the original cost, that would be the value of the equipment. This is the balance in the equipment account. And then it also shows how much expired to date. This is the accumulated depreciation. And like we said, the adjusting entry here would be to decrease stockholders equity as it increases expenses. This is the depreciation expense that has increased. So the way to do it is we put under assets, we have accumulated depreciation for equipment. This is because it's a contra asset. It's the negative here. Again, it shows that it's negative effect on assets because it's a contra asset. And then we debit expenses, the depreciation expense, and we credit accumulated depreciation for equipment. This is to record monthly depreciation. Now, when we post it, like we said here, we post it immediately after the asset that it offsets. So in this case, equipment, we did not touch the account equipment, but right underneath it we have an accumulated depreciation equipment. This is a new account that we used here with the adjustment, with the adjusting entry. The two together, later on, we use accumulated depreciation to offset equipment. So on the balance sheet, it will show as equipment less accumulated depreciation for equipment. And this amount here, this is the book value. This is how much the amount is, the equipment is valued on the company's books. Now, this is different from the market value. This is not what the company expects to get if they sell that asset. It is simply the original cost, but after we take into consideration accumulated depreciation over time. And it always, contra assets, they always show up right after the account that they offset. In this case, it is equipment. To summarize, prepaid expenses, before adjustment, the assets were overstated, expenses were understated. It's very important to understand this. And why? Because until that point, we were saying that we had, for example, over the example of supplies, we were saying that we had $2,500 worth of supplies. However, after the adjustment, we found that we only had $1,000 of supplies. Expenses were also understated because we didn't, up to the moment where we made the adjusting entry, we had not recognized the expenses. So that's why it was understated. The way to prepare the adjusting entry, we debit expenses and we credit assets. Unearned revenues are the other side of the story. This is the other side of deferrals. This is when when the company receives cash before they provide the service or make a sale. In other words, they receive the cash before they earn the revenue, before they record the revenue. And examples of this include rent, magazine subscriptions, etc. Take, for example, magazine subscriptions. In this case, the client or the customer pays in advance for 12 basically, let's say that they pay for 1 year subscription of magazines. In this case, let's say that every month they should receive one volume. So they have the company received cash for 12 volumes, but they haven't delivered any of them. This is why they haven't earned those revenues yet, but they received the cash. And this is why now there's a new obligation that the company has to satisfy. Now they have to basically they have this performance obligation. They need to perform a certain service or to provide a certain product. In the case of magazines, they have to deliver 12 volumes to the client. Now this is opposite to prepaid expenses. This is like we said. In fact, if we look at it this way, unearned revenues for company A can be actually a prepaid expense for another company. So when unearned revenue for the supplier is actually prepaid expense for the customer company. And the way we do that, now we said that with unearned with the original entry, we had an increase in liability. That was unearned revenue. And because it was because when we made the original entry, the trial balance includes the end of before adjustment. The trial balance includes the information of the original entry, and that would say that they had the full. For example, for the example of the magazines, they had the full month, the full year, 12 volumes as liability. But let's say during that accounting period, the company delivered one volume. So originally, they owed 12 volumes. During October, they delivered one volume. So now the company earned one volume. And this is what happened now is that how much do they still owe? Now they owe 11 volumes. So what happened to the liability account? The liability account has decreased, and when liabilities decrease, we debit them. At the same time, they earned this one volume, so their revenues increased, and this is why the company credits the revenue account. So this is why we credit revenue and we debit the liability. Before this adjusting entry, liabilities were overstated. We were saying that they owed 12 volumes, whereas in reality they owed only at the end of the accounting period they only owed 11. So the liabilities were overstated and revenues were understated, because we were saying that they hadn't earned that yet, which also causes net income to be understated as well. So let's look at this example. Pioneer Advertising received $1,200 on October 2nd from Arnox for advertising services expected to be completed by December 31st. Unearned service revenue shows a balance of $1,200 in the October 31st trial balance. Now, Analysis reveals that the company earned $400 of those fees in October. So the original amount, they received cash $1,200, and the original entry would include receipt of cash, and so basically cash was debited $1,200, and we had an increase in liability, and the liability account unearned service revenue, which was for $1,200. By the end of the month, the analysis shows that the company has actually earned $400 of those amounts. So now what happened to the liability? The liability has decreased from $1,200 to $800. Basically, it has decreased by $400. And when liabilities decrease, we debit unearned service revenue, which is the liability, $400, and this is the amount that the company has earned as service revenue because they have already provided those services. Before adjustments, as we said, stockholders' equity, revenues, and net income were all understated by $400. Liabilities was overstated by $400. That was before adjusting, before the adjusting entry. And then once we are done with that, we post it. Once we make the adjusting entry, and this is to record revenue, the explanation would be to record revenue for services performed. The analysis would be unearned service revenue was debited $400, service revenue was credited $400. As you can see also the adjustments, they always they are once again the amount for debits and credits are equal. This is as a summary. Once again, before adjustment, liabilities were overstated, revenues were understated. And in order to fix that, we needed to decrease liabilities, so we debited liability, and we needed to increase the revenues because we recognized new revenues that the company has earned. As a result, we credit revenue. So this is the adjusting entry here. So this is a typical problem. This is where Action Real Estate received a check for $18,000 on July 1st, which represents a 6-month advance payment of a rent on a building it rents to a client. Unearned rent was credited for the full $18,000. Financial statements will be prepared on July 31st. So basically, we need to make the adjusting entry. Action Real Estate should make the following adjusting entry on July 31st. How do we approach that? So the original amount of unearned revenue was $18,000. This was for 6 months. So how much is it per month? It's $18,000 for 6 months. So it is $3,000 per month. We know that the company, now remember here that the company is renting this building to its client. Basically, they earned $3,000 for that month. So they earned $3,000 for that month. How do they make the journal entry? Their liability has decreased by $3,000, and their liability unearned rent, because they earned $3,000 of it. So how much is still unearned? $15,000. And what's the journal entry at this point? It would be to debit unearned rent revenue to decrease the liability by $3,000, and we credit rent revenue $3,000 in order to increase and recognize those revenues. This is another example of adjusting entries for deferrals. The ledger of Hammond Inc. on March 31st includes these selected accounts before adjusting entries are prepared. So basically this is the more or less like the trial balance or certain accounts from the trial balance. An analysis of the account shows the following. Insurance expires at the rate of $100 per month. So we have to recognize the insurance expense. Whenever we talk about insurance that is expiring, now we have recognized a new expense. So insurance expense has increased, and as a result we debit insurance expense $100, and we credit prepaid insurance because it has decreased by $100. The explanation would be to record insurance expired. Supplies on hand total 800. So that means that supplies used, it's equal to 2,800. That was the beginning balance minus 800, and that would be $2,000. So the supplies that were used during this month were equal to $2,000. That would mean that we debit supplies expense $2,000, and we credit supplies because our supplies have decreased, so we credit supplies by 2,000. The explanation would be to record supplies that were used. The equipment depreciates $200 a month. So in this case, whenever we talk about depreciation, we debit depreciation expense, the amount of depreciation, and we credit accumulated depreciation for equipment. As you can see here, depreciation, accumulated depreciation and equipment, they always come together. So equipment, always after that you always find accumulated depreciation equipment, and this 5,000 will be offset, will offset this amount. The fourth analysis, the fourth item would be that 1/2 of the unearned service revenue was recognized in March. So what happens here? This unearned service revenue, the company earned half of it. Half of it is 4,600. And at this point, what the company has earned those revenues, and as a result, we debit unearned service revenue, because this amount was, when you say unearned service revenue, it means that it was already paid before. So the company is not receiving cash. The company is simply getting money that earning the money that they have already received. This is why unearned service revenue, now it is basically earned service revenue. So the unearned service revenue account decreases by 4,600, and the service revenue increases by 4,600. As a result, the adjusting entry would be to debit unearned service revenue and credit service revenue, and this is to record revenue for services performed. Now the other kind of adjusting entries are called accruals, and accruals basically are to record revenues that were earned or expenses that have started to that are incurred. We started, like, those are revenues that we have earned, that the company has earned, or expenses that the company has incurred during this accounting period. However, the payment will not happen now, so they will not be recognized now. Accrual, the word accrual in general means that this is something that is accumulating. So those are revenues that we have not received cash for. So we started earning the revenues, we started accumulating those revenues, but we did not get cash. So when deferrals were received, the cash was exchanged before providing or before the event here, before, let's say, providing the service or making the sale. With accrued revenues, it's actually the other way around. Here we have a revenue that we have earned, but we did not receive cash, and this is where we talk about, in general, about receivables. Examples of that would be when the bank gives a loan to a company. From the bank's perspective, the bank will start earning interest from day one. but the company will not pay interest on a daily basis. As a result, they will pay the bank later on, and for that one, because of that, the bank uh, makes the adjusting entries for this accumulated interest or accrued interest revenue that they have earned during this month, although the company will not be paying them now. And for this one, assets and stockholders' equity are both understated before making the entry. Why? Because we had said that we did not earn the revenues, so stockholders' equity was understated, and we said that we didn't have this asset. In this case, for example, let's say accounts receivable. So how do we adjust for that? We increase the asset by debiting it, and we increase the revenue, or we recognize the revenue and we increase the revenue by crediting the revenue account. Here too, revenues were understated because we hadn't recognized this revenue before until the adjusting entry. We had not recognized the the revenue. As a result, the net income also was understated before the adjusting entry. Let's take this example. In October, Pioneer Advertising Agency earned $200 for advertising services that had not been recorded. So they had not recorded this. They provided the service, but they did not record it. So at the end of the month, because they earned it, they have to recognize it. Remember that under the accrual basis, companies, they must recognize the revenues when they are earned. Because they provided the services, they earned those $200. And because they haven't received the cash, so that basically what happens here is that they provided a service on account. They provided the service without being paid. As a result, the asset, accounts receivable, is debited $200, and service revenue is credited $200. This is money now that the customer owes them. So this is what the customer owes. Now, on November 10th, Pioneer receives cash of $200 for the services that they performed. And usually this happens because companies, they always they send the bill after the service has been performed, etc. But they need to recognize it in the same accounting when it actually happened. They need to recognize the revenue when the service was provided, although by the time they send the bill and they send the check and the company, the other, let's say the customer's company, would pay the bill, it's usually, or it can be in a different accounting period, which is the case here, because the payment was on November 10th, which is in a different accounting period. Now, when the customer now pays the cash, so Pioneer receives cash, they are receiving cash that the customer owes them. It's not like they have performed new revenue, new services, so it's not like they earned new revenue. This is why they received cash, so cash is debited $200. At the same time, what the account that is credited is accounts receivable, because what's happening here is that the customer is paying their debt. They used to owe Pioneer Advertising $200. Now they don't owe them that anymore. This is why this is not service revenue. It's accounts receivable. They are paying their debt. They're not paying for a new service. And this is how we journalize and we post the information from the adjustment. So basically, this is here we're talking about the first transaction here. This is simply to explain what happens later on, but this is the one that we are concerned with, as far as the adjustment. This is the adjusting entry, and this is the one that we have entered here. As a summary, for accrued revenues before the adjustments, the assets were, both assets and revenues were understated because we had not recorded that transaction at all. So the assets and the revenues that the company earned were not recorded. As a result, they were both understated. And to rectify this, or to fix this one, we increase assets and we increase revenues. And so this is why we debit assets to increase it, and we credit revenues to increase the revenues as well. So whenever we need to make an adjusting entry for accrued revenues, we debit the asset and we credit the revenue account. Now, with accrued expenses, this is again the other side of the story. This is where we have incurred expenses, but because we are not going to pay them in cash now, we will record them. So like we said, with accrued revenues, we are talking about receivables, whereas with accrued expenses, we are talking about payables. This one explains payables. In this case, let's talk about the interest now. However, from the company's perspective, the company took a loan from the bank and they need to pay it next year. But interest starts accumulating from the first, their interest starts accumulating from the first day. And the company, because it's impractical to make daily adjustments for the interest amount that they have already accumulated or that they have already incurred, what do? They wait until until the end of the accounting period, and they make an adjusting entry whereby they recognize the interest expense that they have incurred, and because they're not going to pay it now, they consider it as an obligation. Now they owe this amount to the bank. So for example, at this point, the account that is, in order to record this obligation and to recognize the expense, the company increases the expenses. As a result, they debit the expense. Remember, so we debit the expense to increase it, and we credit the liability to increase it, because we have the liability, in this case, for example, it was interest payable, and the interest expense, they were both not recorded until the adjusting, before the adjusting entry, and as a result, they were both understated. So at this point, until this point, they were both understated. We needed to increase them, so we debit the expense account, and we credit the liability account. For example, Pioneer Advertising signed a 3-month note payable in the amount of $5,000 on October 1st. The note requires Pioneer to pay interest at an annual rate of 12%. Now, whenever you are faced with a question like that, you need this interest amount, that you need to calculate the interest amount. So the interest amount depends on 3 things. It depends on the face value. This is the original amount of the loan, and then, so in this case, the face value of the note is the $5,000 original amount, basically. Then the annual interest rate. This is whenever they give you an annual interest rate, you need to also divide it by the time in terms of the year. For example, how many months. So in this case, it's $5,000 multiplied by 12% multiplied by 1/12 because it was for 1 month. And the amount eventually is $50. So what happened here? The company, before the adjusting entry, they hadn't recognized this interest that has accrued. In order to recognize the interest expense, the company debits the interest expense because it has increased. They debited $50, and they also, because they're not going to pay it now, they credit it to the liability interest payable. Now, with the note, we'll talk about that later on in a future chapter. But basically, let's say if it's a 3 months note, that means after 3 months, Pioneer Advertising will have to pay the $5,000 plus any interest that has accrued. They don't need to pay the interest every month. They pay it all once at the end of the period. So in this case, it's 3 months. So after 3 months, the company has to pay the original 5,000, the face value plus interest. So they pay the face value plus interest. As a result, interest will not be paid now, and this is why, because interest will not be paid now, we credit a liability account, interest payable. And this is the analysis. We can see here that both we had the adjusting entry would increase the liability and would also would increase the liability as well as increase the expenses. Remember that the minus here indicates that this is it will decrease stockholders' equity. And in the adjustment, we have debited the expense account and credited the liability account. And here the interest expense is basically the interest charges for the month of October. The interest payable is the charges at the date of the statement, and this is the liability, the obligation that the company has now. We used here interest payable and we did not credit notes payable because we need to differentiate between the notes payable itself and the interest. So basically what we need to here, we need to differentiate between the original amount, which is also called the principal, and the interest that has accumulated or accrued over the time of the loan. Another example is salaries. So Pioneer Advertising last paid salaries on October 26. The next payment of salaries will not occur until November 9th. The employees receive total salaries of $2,000 for a 5-day work week or $400 per day. Thus, accrued salaries at October 31st are $1,200. Remember, so basically here what we're saying is that the company will pay on this day, and then the second payment will be on this day here. However, what about those 3 days here? Those 3 working days, Monday, Tuesday, and Wednesday. The employees have worked those 3 days, but the company will not pay them now. Many companies actually they pay bi-weekly, so every 2 weeks they make a payment. And it happens a lot when there are several days before the next paycheck arrives, or before the next paycheck is basically paid to the employees. Here we have 3 days. Although the company will not pay them now, but the company now, by this day here, at the end of this day, the company owes their employees 3 days. So even if the employees quit, they still owe them this. Now it's an obligation. The company has accumulated those 3 days as an obligation to their employees, and this is called salaries and wages payable because they're not going to pay them. This is a salaries and wages expense that the company has to recognize. Those are the 3 days, but the actual amount will not be paid now, so it becomes a payable. It's a liability. This is why we need to debit. We debit the expense and we credit the liability. So we debit salaries and wages expense. This is to record the salaries that have accumulated before the end of the accounting period. So basically here what we are recording is the salaries that have accumulated between the last paycheck, the last payday, and the end of the accounting period. If we had a fourth day here, it will be calculated. So again, what happens here is that we record the days that have accumulated, or the salaries that have accumulated by the end of the accounting period, and we make the adjusting entry by debiting the salaries and wages expense and crediting salaries and wages payable for the amount of $1,200. Now, as a result here, before the adjustment for accrued expenses, the expenses were understated and so were liabilities. We hadn't recognized the whole transaction. We didn't say that we owed the employees anything, and at the same time we did not recognize the expense. So in order to fix that, we need to increase the expenses. We debit expenses and we increase liabilities by crediting liabilities. So whenever we have an adjusting entry for accrued expenses, we debit expenses and we credit liabilities. So Microcomputer Services Inc. began operations on August 1st, 2014. At the end of August 2014, management attempted to prepare monthly financial statements. The following information relates to August 1st. So we need to prepare the adjusting entries here. On August 31st, the company owes its employees $800 in salaries and wages that will be paid on September 1st. Because they are going to be paid in the next accounting period, we need to make an adjusting entry. And this is, we need to make an adjusting entry. And this is accrued expenses. So how do we make a journal entry for accrued expenses? We debit the expense, we credit the liability. So in this case, we credit salaries and wages expense, and we credit salaries and wages payable. The second one is adjusting entry that we need to make is to accommodate for basically to take into consideration or to recognize the interest that has accrued. The company borrowed $30,000 from a local bank on a 15-year mortgage. The annual interest rate is 10%. Here again, you need to calculate the amount. So the interest amount in this case is how much? The interest amount is the face value, which is 30,000, multiplied by the annual interest rate. This is 10% per year, multiplied by 1/12 because it's for 1 month, and that amount will be 250. So the amount of interest that has accumulated during the month of August is $250, and the journal entry, the adjusting entry for this one would need to basically increase or recognize $250 interest expense. So we have an increase in expenses, so we debit interest expense $250, but because the company will not pay it now, it becomes an interest payable liability. So we credit the liability interest payable $250. The third entry is for revenues for services performed but unrecorded for August, which totaled $1,100. Here, the company performed certain services, but the company will not be paid. This is accrued revenues, and as a result, because they performed those services on account, we have an increase in the asset accounts receivable. So accounts receivable is debited $1,100, and service revenue is credited $1,100. This is a summary of the basic relationships and this state of the accounts before adjustments and what the adjusting entry needs to be recorded. This is just a summary of what we said. So for prepaid expenses, before the adjustment, assets were overstated and the expenses were understated. The adjusting entry for this one would be to debit expenses and credit assets in order to increase the expenses and decrease assets. Unearned revenue, the unearned revenues before the adjustment, liabilities were overstated and revenues were understated. To fix that, we debit liabilities and we credit revenues. That will be the adjusting entry. For accrued revenues, both assets and revenues were understated, so we debit the asset and we credit the revenue. For accrued expenses, both expenses and liabilities were understated, so we debit the expenses and we credit liabilities. This is basically a summary. This table is a summary of all the 4 types of adjusting entries that we studied so far. And once we have those adjusting entries made, we can prepare the adjusted trial balance. And this is usually prepared after finishing with all those adjusting entries. Then we journalize them and we post them to the ledger. And again, here it's like the trial balance. We try to prove the equality of total debits and total credits. And this adjusted trial balance, the information in the adjusted trial balance is the basis of financial statements. This is the information. This is mostly the information that we use in order to prepare the financial statements. And this is how the adjusted trial balance looks like. This is the same one for the same company. And as you remember, that was the trial balance before taking into consideration or before adjusting for before making the 4 types of adjusting entries. And after finishing with the adjusting entries, this becomes the adjusted trial balance. As you can see here, the accounts that were involved right now are in red to show the differences, and here again total debits and total credits are equal. And as you can see, in many cases we have more accounts here than we have in the trial balance, because certain accounts were not included here, such as accounts receivable. We didn't have any accounts receivables here. Now we do. We didn't have for example, supplies expense. Now we didn't have supplies expense, and now we have here supplies expense, for example, and other like depreciation expense, etc. Those were not on the original trial balance. And like we said, this information is used in order to prepare the financial statements, mostly the income statement, the retained earnings, and the balance sheet. And like we did before, like we discussed before, we always start with the income statement. We take the revenues and the expenses. So this is the revenues, and we take all the expenses and we use them to prepare the income statement. Once we calculate the net income or net loss, we take this, we add it, and we use it for the retained earnings. And from the adjusted trial balance, we get information for the dividends here. This information here, we get the dividend information from the adjusted trial balance, and using those two, and here in this case we had the retained earnings. Because the company is a new company, supposed to be a new company, the retained earnings balance was 0. But basically we get the retained earnings beginning balance from the adjusted trial balance, we get the dividends from the adjusted trial balance, and we get the net income from the income statement here. Now once we calculate the ending balance of retained earnings, we use this to prepare. We use this to put it here on the retained earnings for the retained earnings under stockholders' equity. Here we get on the balance sheet. We start with all the assets, and we take the balances from the adjusted trial balance, then the liabilities, and after that we take the common stock. From all these are from the adjusted trial balance. The retained earning amount comes from retained earnings statements. And here again, the total assets must equal to total liabilities and stockholders' equity. Here we will review a few concepts that we have already discussed. We discussed some of them previously. The first one is that the information that companies are expected to report must be useful for the they must be useful for the stakeholders. In other words, first of all, they must be relevant. In other words, the information, it has to be accurate. It has to provide some accurate predictions for the future, and it must also have a confirmatory value. At the same time, this information must faithfully represent the financial situation of the company. Basically, it has to include to be complete and include most of the important. Basically, it has to include all the important information. We shouldn't exclude any information from these reports, and it has to be also neutral and not biased, for example, to show a better position of the company or something like that. And there are certain enhancing qualities that the company might basically that the information can improve the quality of the information. For example, the reports must be in a way comparable. It would basically, like, the standardization of the reports allow the users, the key stakeholders, to use this information to compare companies. Basically, it has to enable the users to run comparison analysis, basically between companies, from company A to compare company A to company B. And they have to be consistent over time. The company has to use more or less this similar accounting methods in order to enable the user to evaluate the performance of the company over time. And they also need to be to be able to verify this information. So the users must be able to prove that it is free from error at the same time, and the information has to be timely. And by that we mean that, for example, if the reports are published 2 years later, they are useless. So they have to be published in basically a short period of time after the end of the year, or in order for them to be useful. And of course, they have to be understandable by the users, and so that they would be able to incorporate it in their decision making. Now, those are the assumptions that we talked about before. The monetary unit assumption, this is where we said that transactions must be expressed in monetary values in order to be recorded. The economic entity assumption states that the activities of the entity must be kept separate from its owners as well as from other entities. The periodicity assumption, this is what we discussed before, that the economic lifetime of a company can be split into artificial time periods such as a year or a month or a quarter. There's also the going concern assumption, and this is where let's say the general assumption is that the company will remain in business for the near future or for the foreseeable future. You don't expect it to go bankrupt anytime soon. This is the assumption. And we talked also about accrual basis accounting. This is where revenues are recognized when they are earned and expenses are recognized when they are incurred. And we said that under US GAAP, companies are required to use the accrual basis of accounting. And here we also talked about the measurement principles in previous chapters. We talked about the cost principle, that the companies are required to initially record the assets at cost. This is the cost of acquiring a certain asset, and then in subsequent accounting periods they continue to report it under cost. And this, for example, this is for equipment, buildings, etc. Whereas the fair value principle states that the companies originally they record the asset at cost, but they make changes later on based on the fair value of the asset. However, under US GAAP, companies are required to use the cost principle, except for securities, for assets such as securities and stocks, etc., where the fair value can be easily obtained from the stock market, for example. And revenue recognition principle, this is where this is under accrual basis. It means that revenues are recognized when they are incurred, so basically when the service is provided or the sales is made, and expenses are recognized when they are incurred. And we also said that expenses, they follow the revenues. By that we mean that this is like the expenses, they have to match the revenues for during the period where they were used in order to generate those revenues. During the period where they were incurred in order to generate those revenues. And full disclosure principle, means that all the information that might affect the decision making of the information user must be disclosed. And then we have also certain constraints in financial reporting. This is the materiality constraint and the cost constraint. There is basically a trade-off between the two. The materiality constraint is talks about whether this information is material and enough to make it to affect the decision maker. For example, if there was a change, if there was a discrepancy or something in the numbers or something like that of basically $50,000 for Google, that would not be relevant. But for a small company, yes, it would be material because it will affect the decision making of the investor or the creditor. So materiality is about whether the information in the financial statement will impact or will affect the decision making of an investor or creditor. Will it be big enough to affect their decision? On the other hand, the cost constraint talks about how like the cost benefit of adding more information. Well, of course, the more information, the better the the higher the transparency. But at a certain point, the costs they would largely outweigh the benefits of added information, and the cost to the companies might be very, very high, while the benefits to the users might not be that important or material.